Today, we're talking to Chris Barnette, who's the Business Development Manager at Inspira. We're going to talk about how you can use your self-directed IRA to invest in real estate. But hold on, if you already think you know how to do this, be sure to listen anyway, because when we get to the end of the show, I am absolutely mind blown about what I learned and cannot wait to do it myself. So definitely listen to the whole episode.
You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
Chris, welcome to The Real Well Show.
Thank you, Kathy. So excited to be here. Thanks for the invite.
Well, we still have a lot of people after running this show for 20 years, but there's still a lot of people who don't know about self-directing their IRA. So let's start with who you are and what you do for people, and also how you're different than other self-directed IRA companies.
Absolutely. Thank you for that. Yeah. So Chris Barnette, I'm with Inspira Financial, and at Inspira, we are one of the industry leaders in self-directed IRAs, but that's just one line of our business. We actually do health, benefits. We partner with a lot of the Fortune 500 companies with their automatic rollovers. So with like Chase and Bank of America, when they have employees leave, they will actually partner with us to roll over those old 401ks for those employees. So we're large. We have about 8 million clients across all of our lines of business, about 65 billion under custody. And we're privately owned, and we're really proud of that. We've been in business for about 20 years. And I think one of the cool differentiators for us is we're one of the only custodians that offers both traditional and alternative investing, which is really nice. So what that means is with a self-directed IRA with us, you can actually invest in the traditional public assets, stock, bonds, mutual funds, and then obviously get onto the alternative side with private companies, syndications, promissory notes, et cetera. So historically, you usually had to pick one or the other, right? If you're at Schwab, Fidelity, Vanguard, you're locked into the public side. And that's why you would then have to pick a self-directed IRA with a trust company or somebody that would allow that private holding. And then vice versa, right? Once you were done maybe with that alternative investment or that syndication, it paid out, it was, okay, well, now I have my cash here. Do I transfer it back to Schwab Fidelity? So we're really happy that we can offer both of those options for investors under one roof. We're the one-stop shop.
I see. Okay, you kind of answered my question because I thought, why would you self-direct and then invest traditionally? What would be the point?
Well, here's kind of a good example. So like we offer money market accounts here, right? So as people are invested, let's say they're in with Real Wealth, they're into a syndication, right? And they start getting some of those returns. Well, instead of that cash coming in and just kind of sitting as a rock, or them having to transfer it back to like Schwab Fidelity to park it into something interest bearing, we give them that option. So it really is all under one roof, investing with us. So that's kind of a big differentiator. And then obviously our level of customer service. We actually just created a priority care team. So as we're working with sponsors and companies, we have a team of dedicated individuals that actually help onboard and streamline that process for new investors, just to give them a really good experience right out the gate.
So a lot of people still think that they cannot invest their retirement funds into alternative assets like real estate. So would you just mind explaining how that works?
Yeah, absolutely. Well, you absolutely have that option. There's really two ways that once you open your self-directed IRAs to fund it, right? So you can roll over funds from an old 401k, previous job that you may have had, or you can transfer the funds from another IRA, whether that's a traditional Roth IRA at Schwab, Fidelity, Vanguard, and transfer some of those funds over. So I'll just take the IRA example. How it works is, let's say you wanted to invest $50K into a syndication and you had, some money in an IRA at Schwab, Fidelity, Vanguard. You would just liquidate that $50K, right? What you wanted to pull over for the investment, pull it over to the self-directed IRA. And then we actually set the investment up in the name of the IRA. That's kind of the magic sauce. People are like, yeah, I know what you're saying. They're like, well, how the heck am I going to pull the money out of the IRA and then invest into the syndication without there being a distribution? Well, the money's never really leaving the IRA. That's the beauty. So once the money is transferred from your IRA at Schwab or Fidelity to your IRA at Inspira, then we will, on the investment document, set it up in the name of the IRA. So it'll say something like Inspira Financial FBO for benefit of the investor's name, account number, and then my team will actually wire the funds directly from the IRA to the sponsor to secure the investment. in the name of the IRA. And then any of those subsequent returns and so forth flow directly right back into the IRA. So it's closed circle, no money ever leaves, and that's what keeps it tax compliant and doable.
And speaking of compliance, the IRA owner is really not supposed to be active at all. So let's say that the investor wants to take their self-directed IRA, invest it into a syndication. Should they be putting that? Should they be subscribing in their name or in the name of the IRA, or should they have you guys fill out the paperwork to stay totally third party?
Great question. So to answer your question, first, it definitely, they should be kind of hands off. It should be set up in the name of the IRA. Again, that's why I'll know that subscription agreement, right? That investment into the syndication, it'll be set up in the name of the IRA. And then that's what you're paying a custodian like Inspira to do. So my private equity team will process those documents before we send the funding to the sponsor to secure the asset. We'll send what we call read and approved by documents. So basically, the owner of the IRA is not physically signing. They're signing the read and approved by, but then an actual third-party custodian is signing the official documents to solidify the investment.
Got it. Okay.
Yeah.
But let's say that you were going to use those self-directed funds to buy a rental property, and you needed to have some work done. How do you go about making sure that you are not actively involved or participating in that? Because again, that's a big no-no, right?
Definitely. Great question. And I may be a little long-winded, but I'm just going to give
Just go for it.
Cool. I'm just going to jump in. So you open up the question of disqualified, basically,
yes,
transactions, right? And really, when we talk about a prohibited transaction, it's really people that are prohibited. That's what are prohibited from directly dealing with their IRA. So in the terms of a self-directed IRA, those disqualified people are the investor themselves, their spouse, linear ascendants and descendants, so think straight up and down from you, parents, grandparents, children, grandchildren, and any companies that any of those people own, control, manage, or are highly compensated by. So that's just long wind of saying, to your example, we get this question a lot, right? People call in and say, hey, I heard I can do this self-directed IRA. Like, I want to get that beach house, I'm going to rent it out. And then me and my wife are going to go down there a little bit, use it throughout the year when we're not renting it. And I have to say, I hate to bust your bubble. That's an awesome idea. I love it. Unfortunately, you're disqualified from using that IRA directly, right? Awesome. You can set it up. You can rent it, Airbnb it, do whatever you want. You and your wife can't stay there in the eyes of the IRA or the IRS, right? That you would be prohibited from getting that individual benefit. Now, to answer your question on, let's say, there's a broken window, the AC unit goes out, those funds actually have to come from the IRA as well. So any expenses that are incurred by that property that the IRA owns have to come from those expenses have to come from the IRA itself. So if you own it, you can't just, take the 10 grand out of your personal, checking and pay for that AC. Again, like in that term, you would contact our company, right? We help with that. We have what we call expense pay. So you just go into your client portal, submit the expense for that to be paid, and then we would send the funds directly again from your IRA to cover those. So when you start talking about rentals and some of those more active investments where some of those can kind of come up, I always try to tell people you probably want to have a little bit more money left over in your IRA, right? If the house costs $300K, you probably don't want to use all $300K, because if something comes up, you may find yourself in a little bit of a panic if you have some expenses.
Right. Yeah, because you would have to just contribute more money to the IRA, right? And then the IRA
exactly
pays.
And the IRA, so you're exactly right. So and on the contribution, you're capped at $7,000, or you get $8,000 if you're over 50. So that doesn't go a whole long way, right? If it's something a little bigger. Now, the beauty is you can always roll over additional money or transfer additional money from your IRA, but it's just things to always try to talk to people when we're doing those consultations about what it actually looks like and the processes of investing with your self-directed IRA.
And like, you can't even paint it, right? Like you can't, you have to be so careful about what you do on that property.
It's so crazy. Yeah. Painting, technically you're not even supposed to do like the landscaping or the upkeep,
Mm-hmm.
Now that's the black and white answer, right?
Yeah.
We have to give, people always say, well, what if I just, pull some weeds or something, like, listen, the IRS probably isn't hiding in your bushes, right? We're waiting to pounce on you, right? If you like mow the yard or something, but we're going to tell you the black and white, really, you're not supposed to benefit that property. And the whole reason is, honestly, because in the eyes of the IRS, you have two sets of money. You have your personal money, right? We work, we have our W-2 jobs, we pay for golf and beer and fun and living, and then you have your retirement funds that are tax exempt, that are really geared toward helping you out in retirement, and they have to run parallel. And so anytime you start crossing over your retirement funds with your personal funds, that should be your kind of stop red flag to say, hey, should I be doing this?
Yeah.
And you can always call us or another, trusted individual to kind of to talk through that situation.
Yeah, there's some things you could probably get away with, like don't have receipts if you are going to paint it, like pay cash.
Exactly.
But a bigger issue would be as if like, oh, I'm just going to have my kid move in, or my I don't know. What are the rules around arm's length transaction?
Yeah. So like I said, so when it comes, it's really yourself, spouse, parents, grandparents, kids, grandkids, and their spouses. So like, a popular one, and I love the idea too, because I'm a parent myself, right? People call in and they'll say, hey, I want to get this rental property. My daughter's going to college. I'm just going to get the house, right? She can stay there for free, and then I'm going to charge her 3 roommates rent. And I'm like, that's a genius. I would do it too, but you can't. Like, that works. The other 3 friend roommates could stay there, but technically your daughter can't, right? Because she's one of those prohibited people. Now,
but do it outside the IRA. That's still a great plan. Just don't do it with the IRA.
That's a great plan, right? But when they start, that's one of those things though, where those very specific prohibited transactions come into play. And it's that is very black and white, right? So, I mean, if it's Uncle Bob, Aunt Sally, a cousin, best friend, all those people are golden, right?
Yeah.
Can't be your kids or grandkids, parents or grandparents, or their spouses. That's your arm length separation that you have to be careful of.
All right, let's talk about the forbidden, the the idea that you could actually be taxed within your IRA. I mean, this is something people would want to avoid at all costs, I would think. But there are cases where you might have done something that might trigger tax on those profits within the IRA, and that's specifically UBIT. So tell us a little bit about that and how to avoid it, or when it might be okay. Maybe sometimes it's like, oh, it's just the price you pay.
Exactly. So I'm glad you jumped into that one, Kathy. So the UBIT. So a lot of people in the SDIRA world, they bring up UBIT. It's like another one of those 4-letter words, right? That we just are like, don't want to talk about. To me, I like UBIT. And right off the bat, I'll tell you why. One, UBIT only comes into play whenever you've made money, right?
Yeah.
So I always tell people it's only on your gains is where UBIT comes in. And that's a lot better than me losing money, right? I'll always pay a little bit of money to make money. So right off the bat, if you got UBIT, you got a pretty good problem. You've made money. So, and how it comes into play really with using syndications is because it's debt leveraged, right? Most of the time there's, a loan out on the property, for a syndication deal, multifamily, and then you're getting some money, through SDIRAs or private investors. So that's where that UBIT comes into play, is whenever that property or that project is debt leveraged. Now the beauty is you can also take the depreciation and offset some of the costs really to get that UBIT almost down to nothing. So for example, the first usually 2 or 3 years of a syndication, right? There's a lot of construction, there's a lot of costs, and you get to take those and realize that depreciation, like from your K1s, that first, second, third year, you can offset that UBIT that you have at the end. And in most cases, our investors get it down to nothing or almost nothing.
And UBIT stands for unrelated business income tax, right?
That's exactly right.
Yeah. Okay.
Yeah.
Now, what if it's an active business? Then is it called something else, where let's say you're in a syndication where they're flipping houses, they're not holding them, and you're an equity partner in that. So technically you're in the flipping business, or building new houses and selling them retail. Now you're in the building business. You're not in the investment space of buy and hold or lending. So then what kind of taxes might you face in that case?
Really, it's just a UBIT. So and the subset of UBIT is called UDFI, unrelated debt financing income. And again, that's anytime you're debt leverage. So that could come into play if you bought a house and you didn't use the whole funds from your IRA, right? Same example with the syndication. So let's say I want to go buy this $300,000 property. Well, if I only have $150,000 for the down payment out of my IRA, and I go and get a non-recourse loan, is the only loan an IRA can take for the other $150K, immediately I'm 50% debt leveraged, right? And which that's okay, right? And the IRS does that to kind of level the playing field, because if I'm just going to put a down payment, get 3 or 4 properties and make money off somebody else's money, versus putting the whole thing down, then I'm probably going to have to pay a little bit of taxes on that. So again, that's just when it's debt leveraged. A lot of times the fix and flips and some of those really don't incur anything, because you don't have capital gains tax or any of those, as long as you're keeping that money within the IRA, right? And that's the beauty of the IRA is a lot of people, if you're not using IRA money, they like to use the 1031 exchange or some other tax deferred strategies that you really don't have to worry about whenever you're using a self-directed IRA, because you're in an IRA already, and the same tax rules don't apply in a lot of those instances. So to answer your question, long-winded, really the UBIT, that unrelated business income tax, is really the only time taxation would come in. And just think, if you're debt leveraged in a property yourself or in a project overall, UBIT definitely could come into play.
Okay. Also, I've noticed in some of our past syndications, it's important for investors to know that if you're investing in one of our syndications where we're building homes and selling those homes retail, and it is a business, but we're taking the profits from the sales of those properties and building more, then you could potentially be taxed on the income that those property, we sell a property for a profit and the whole entity gets taxed on that, but then we're reinvesting. So it's phantom income. So it's really important for people to understand that if you're investing in any kind of active business as an equity partner, that you could run into that. So like with our multifamily fund right now, we're not doing that. We're buying multifamily properties, we're renovating them, renting them out and holding them. So it's taxed better than some of our other, at least in terms of an IRA and probably outside the IRA, because it's more of a long-term investment versus a flip or a build.
Absolutely. Yeah. Great point. You're absolutely right.
Yeah. So just be aware of this phantom income, because just like you said earlier, if all of a sudden you have to pay tax, but you didn't get any income, you didn't get the profit yet because it's being reinvested, then you're going to have to come up with that tax money somehow. And if you don't have enough money in your IRA, that could be a problem.
Absolutely. Part of that education piece for sure up front, right? Just to make sure there's none of those surprises.
Yeah. Just make sure you, with any syndication, read the tax implications, bring it to your CPA so that you really know how that's going to affect you. It'll be different for everybody. But I love that you are letting people know not to be afraid of UBIT, that yes, there's a chance you could be taxed because you made money. But it's just, if you made a lot of money, then that's okay. And how much tax are we talking about? I guess it depends on the individual, but.
Yeah, it depends. That taxable rate is whatever tax bracket you're in individually.
Okay, so just
the rate. Yeah, just the
Yeah.
rate. So just kind of know what rate you're in. But again, like I said, by the time you take your depreciation and some of the other deductions that you could take, you can get it down to where it's really not much at all, especially in the grand scheme of, sometimes these deals can double, your money. So,
or if you're in a low tax bracket, it's probably, you're not going to be as affected possibly
exactly.
as somebody who's in a higher one. Yep. Always run it by your CPA. So important.
It is. That's what we tell everybody, right? Like, we will give you the information, and we are, experts in IRA and the do's and don'ts and the compliance, but we are not tax professionals or legal professionals, right? So we will always defer, if there's specific questions like that, really to talk with your professional on your individual circumstance, right? And see how it affects you.
Yes. Never take when we talk about taxes, never take it as advice. Always only get your advice from a CPA or a licensed professional.
Absolutely.
Okay. Would you mind, we're going to wrap up, but any case studies that come to mind of people who've really successfully used their self-directed IRA to build their wealth?
Yeah. So honestly, there's so many success stories. Absolutely. Honestly, and I'm not trying to sound cliche with that. I thought, maybe a cool strategy that I would share that we see, especially in terms of syndication, maybe instead of a specific case study, it is kind of doing a Roth conversion midstream. Have you heard of
I
this
don't
play?
know.
No? Okay.
Please share.
Well, so like we talked, right? So during the first couple years, usually, when you're in a syndication, it's going to be cost heavy, a lot of expenses. So traditionally, in those first couple of years, your investment's going to be a little bit lower, right? So a play and a nice strategy that some people have utilized is you start the investment in the traditional. So let's say I want to invest 100K into this syndication. Started in the traditional IRA, and then at that second or third year, when it's at a lower value, a decreased value, you can actually have a third party appraise that value of your investment at that point in time, and then do a Roth conversion at the lower amount. So let's say I started at 100K, in year 3 with that depreciation, it's down to valued at 60K. Well, I can convert it in kind, the investment as is, over to the Roth IRA, pay the tax on the 60K to get it into my Roth IRA, and then have it in the Roth IRA to come back up, in year 4 or 5 or down the line, right?
Dang, that's fancy stuff
That's
right
pretty cool.
there.
That's pretty cool, right? Because everybody wants more Roth dollars. So,
Yeah.
but
Everybody
the only,
wants more Roth. That'll be
everybody
the
wants
show
Roth.
the show name.
But the only caveat of the Roth is you have to take that hit up front, right? So it's a lot harder to take. Man, I don't know if I want to pay 30 or 40K on that 100 grand, right? But if I can start it in the traditional and then wait till it's devalued a little bit in the middle of my investment, so to speak, and I'm only paying taxes on 50 or 60K, that's a little bit more palatable. And then let's say it runs back up to 150K, right? Now it's that 150K is in a Roth IRA versus
I feel like our listeners should send us a big check for that advice. That's amazing. Thank you.
But that's some of the things, right? That's some of the strategies that our staff, our company will talk through, right? And again, make sure that makes sense with your CPA, with your tax professional. But those are some of the strategies that are really cool that you can do within an IRA and really help
I love that.
build your wealth. Yeah,
we're gonna have to do a follow-up webinar at Real Wealth when we're going over the fund details again and how that could
for sure.
That could be a game changer. Fantastic. Wow, I learned something every day on my show. That's why I do it. I hope y'all are learning too. Oh my goodness, Chris, thank you so much for joining me here on the Real Wealth Show. That was really great. And thank you for joining me here on the Real Wealth Show to get access to resources like this, amazing professionals who help our investors dramatically increase the speed at which they could build their portfolio. If you want to learn more, just visit realwealth.com/Inspira. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show, and we will see you on the next episode.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.